Hello everyone, I'm real estate economist Matthew Gardner, and welcome to this month's episode of Mind the Housing Market. A policy proposal that recently came out of the White House plans to limit investor purchases of single-family houses, and their stated goal is to improve affordability and expand home ownership opportunities for families and for first-time buyers. Well, the plan's already causing a stir amongst those interested in real estate markets. So today we're going to take a look at what the proposal involves, what impact institutional investors really have on the market, and then we'll discuss whether it could have any form of tangible impact when it comes to addressing the housing affordability crisis that we face as a nation. So let's get to it. Well, the central idea of the policy is actually rather straightforward. Large investors would be prohibited from acquiring more single-family homes because, as the White House puts it, homes should primarily function as places for people to live rather than as large-scale investment assets that are accumulated by corporations. So who are these investors who apparently play such a big part in the housing market? Generally speaking, they include private equity firms, real estate investment trusts, as well as large corporate landlords. And you may have heard of companies such as Blackstone and American Homes for Rent, who are both very big players in this space. Most people define institutional investors as ones who own a portfolio of at least 1,000 units. So that's who they are, but will this plan have any impact at all? And my view on this is pretty straightforward. I don't believe that it will. You see, data shows that these big institutions own just somewhere between 2 and 3% of all single-family investor-owned homes in the United States. Although 2 to 3% is not a huge number, it's not tiny either. Or is it? You see, if you look at their share of the total single-family market, and not just their share of investor-owned homes, well, things look somewhat different. Institutional investors' share of total single-family homes is somewhere around 0.7%. That's right, less than 1%, around roughly 600,000 units out of 87 million. Most single-family homes in the United States, as we know, are owned by families, and then that's followed by small mom-and-pop landlords. That's followed by smaller-scale local investors, and finally, well, then, bottom of the list, it's these big corporations. Now, these numbers tell me that the impact of blocking institutions from buying more homes will be not much at all. Now, I'd also note that institutions actually have been net sellers of homes over the past few years, not buyers. But a far bigger issue for me is that adopting this policy really wouldn't have a positive impact on housing affordability. Why is this? Well, the nation's affordability challenges stem primarily from a shortage of new housing supply, not because corporations are snapping up every home that comes on the market. Now, the US has underbuilt homes for years, and simply restricting who can and cannot buy existing homes, that doesn't increase the total stock. Broader forces, including interest rates, zoning rules, construction costs, labour shortages, they all play major roles in determining home prices as well as home rents. So from this viewpoint, limiting institutions may change who can buy homes that are on the market, but it's very unlikely by itself to resolve the structural affordability crisis that we face. But what if these corporations were forced to sell the homes that they already own, right? I mean, that would help, surely. Well, the answer to that would be yes, but. The White House plan appears to only prevent future purchases. It doesn't force them to liquidate existing portfolios. And even if that was part of the administration's plan, I'm sure that it would be fought very hard in court for a lot of years. It's my belief that the long-term improvements in housing affordability require one thing: more housing supply. As I see it, a far better and likely far more successful plan would be for the government to increase pushing for more reform of restrictive zoning policies, to work on further streamlining the permitting process, as well as to encourage, where appropriate, more infill and higher density development, especially in land-constrained markets. Here's another idea, and maybe they could look at land that's already owned by cities, counties and states. Here's where I see the real low-hanging fruit. Or what if the federal government started pushing states harder to allow building on smaller lots, especially in those land-constrained markets? That could greatly add to supply and therefore improve affordability, especially for working and middle-class families. If they didn't like it, what if the Fed sweetened the deal a bit by offering the states financial bounties that were actually tied to the number of homes that did get built on smaller lots? If that's confusing, let me give you an example. Let's say the Fed paid an average bounty per lot of $37,500. Well, that amount could fund 240,000 single-family homes per year. Yes, it would cost roughly $9 billion. Now, I know the government spending more money given the current fiscal deficits that we have may sound like a stupid plan, but is it? Years 1 and 2, well, they could be funded by repurposing discretionary federal funds which are already in hand. And Congress, well, they could fund years 3 through 10 simply by repurposing existing affordable housing subsidies. Anyway, as I see it, limiting institutional investors may possibly influence the market at the margin, but far more comprehensive solutions are needed to address affordability, and that requires policies that support building more homes. As far as I can see it, the dream of home ownership, it's not dead, but I believe it's on life support. Solutions need to be big and bold, and will have to go far further than simply stopping corporations from buying houses, or even trying to implement wildly impractical mortgage products. And that's what I think. I hope you found my comments to be of some interest, and if you did, please subscribe to my videos, and you can do that by hitting the link below. So until next time, take care. And I'll be back again next month to take on another topic that's of interest to real estate brokers and their clients. Bye now.